Good morning, everybody. Welcome to the Game Plan. My name is Gareth Soloway, coming to you live from the Verified Investing Studios over here in Florida. Again, I am here to dissect the markets on a technical basis. No emotion, no nonsense. Just what are the charts and probabilities telling us? There's so much emotion in the markets. In fact, again, just hearing some of the reports recently again about bullish sentiment in the markets. We've seen what crypto has done lately before this latest pullback, and the kind of the emotional toll that takes on people. And then the stock market here, we continue to be very close to new all-time highs, but I continue to see these warning signs that I feel compelled to tell you about. And again, it's not warning signs that I'm just kind of thinking about or emotional about. It's the technical charts and the setup. So we're going to get into all of that today. Look at the big movers of the day as well. But first, let's start with the S&P 500. All right, so S&P is basically unchanged for the day. We can see this is Friday's action, right? So right here we have Friday, the stock market rallying on that PCE data that came in better than expected. And again, this is the favored gauge of inflation for the Federal Reserve. So we saw CPI upticking a little bit, then PPI was very, very hot. Then PCE brought it back down a little bit, and that enabled the market to have that Friday rally, which brought us back up. Now, again, a couple things about that. Number one, it still shows us that the Federal Reserve is going to have to be hawkish. So yes, PPI, or I should say PCE inflation, was not as bad as had been feared, but it certainly wasn't good, and we still are seeing inflation moving up. As many of us people that are out and about, we can still tell that those prices are inching higher. Now, as we looked at Friday's action, the second half of the day was sideways consolidation and fading a little bit, and then overnight on Friday afternoon, and then this morning, we see basically sideways chop, so sideways consolidation. Now remember, the stock market closes half day tomorrow, is closed on Wednesday for Christmas, normal Thursday and Friday of this week. But what does that mean? It means volume is going to be lighter. All right, now again, I want to talk about some things in relation to the bigger macro scale in terms of forecasting 2025, but I also want to go over the January effect, one of my favorite plays coming into year end. And again, what I'm going to do is every day this week, I'm going to unveil a January effect play. And just to explain what the January effect is it's an amazing phenomenon. Essentially what you have is into year end, stocks that have been beaten down the entire year will see tax loss selling, right? So again, institutional tax loss selling, retail tax loss selling. So it makes stocks that have been beaten down all year long that are trading near 52-week lows, it's almost impossible for them to bounce into year end in the next week or two going into January 2025. But once you get past the end of the year, that selling pressure is now void. There's no more selling pressure. And so what you look for is the January effect, where these beaten down names get a beautiful rally because all of a sudden you essentially eliminate almost all the sellers, and these things can go up precipitously. So they almost get beaten down more so into the end of the year because of tax loss selling. But if you think about it, if you're an investor and you want to sell, you're obviously going to sell by year end because you want to use that to offset the taxes you'll owe the government from the stock market being up so much this year. And so ultimately, once that's over, if you weren't going to sell for tax loss purposes, there's really no reason to sell anymore, and that enables these plays to go up. So we're going to go over one of those plays today, and every day this week that I do the game plan, we will touch base on a new one. All right, let's get into some of the bigger macro here. Now, first and foremost, I do want to take a look quickly at essentially what we're seeing in terms of the Federal Reserve, because things have changed dramatically. So if you go to the homepage here and we scroll down, and by the way, just so much amazing. Here's insider buying and selling for the last 30 days, the current debt, which just keeps getting worse and worse. Obviously, the new live events. All of these updated charts every weekend. These are updated here, folks. Bitcoin levels, Ethereum levels, technical analysis for interest rates, the stock market, again, all of these type of things. But what I'm going to focus on more so is at the bottom here is the Fed Watch tool. And I'm going to bring that up in big form, and we're going to take a look at this. So let's come back over here and just take a look, because what we've seen is that essentially since this latest inflation data and the Federal Reserve comments after their last 25 basis points is that we had expected, per the Fed Funds Watch tool, we had expected multiple cuts in 2025. We'll take a look at what we're seeing now, folks. We are now seeing that essentially we are down to just one cut in 2025. So think about this. The market had been pricing in valuations of stocks based on a much lower interest rate. Now, remember how this works. It's fascinating. Is essentially the lower interest rates go, the more people want to be in stocks. Because essentially, if interest rates are super low, why would you put your money in a money market making 1% or 2%? But if interest rates are higher, you have more of a kind of a question. You say, well, stocks are really toppy. They're really in the bubble environment here. You know, maybe there's kind of a dot-com type thing going on here. I don't want to take the risk. Yeah, I could make another 10% there, but if I could make 4 or 5% with the safety of a money market, why would I take that risk? So the higher interest rates stay, the less attractive stocks look because people have an alternative with essentially little to no risk. And so what we're seeing here in the Fed funds rate or the watch tool is that, needless to say, we have our January meeting right here. And right now, it's looking like no cut whatsoever. This is where the current Fed funds rate is right here, okay? So it looks like in January and March, it doesn't look like any cuts are expected, right? The odds are no cuts. However, once we get to this meeting here in May 7th, 2025, the odds are now favoring a rate cut. But look, the rest of the year, no cuts are expected. And again, this is one of the reasons why you could say, well, why do the markets tend to move inversely to interest rates is because the higher interest rates go, the more people in the stock market will say, I'm feeling a little nervous about this market. You know, we have potential tariffs, we have these geopolitical concerns. Maybe I'll just move my money out of stocks and into the bond market, for instance, get a nice 10-year yield or a money market. And that's, again, why you have that general inverse relationship with the bonds or the interest rates and the stock market. All right, so I just wanted to go over that really quickly there today on the action. And by the way, all of this is updated on our website daily, so you can all get this information beautifully each and every day, what the latest Fed Watch tool is. We have our economic calendar, our earnings calendar, not really any earnings this week to speak of, but nonetheless, it's all here at verifiedinvesting.com. All right, next up, we have to look at this chart here, guys. I'm going to walk back over to the big screen and talk a little bit about this. So this, folks, is a chart using the logarithmic scale. So I flipped it to log chart, and again, log chart looks at percentages versus dollar amounts. And the reason why, when you look at longer periods like, 20 years, 30 years, 50 years, in this case almost 100 years back, it's important to look at the log scale to get a better view versus the craziness. When the S&P was like 5 points over here versus where it is now at 5,000, 6,000 currently. Okay. The reason I'm bringing this to your attention, we talk about forecasting the markets and what could be occurring into 2025. And one of the biggest concerns I have here is that we're now into some major levels. Remember the Bitcoin level I had that I gave you guys a month ago? I said, guys, it's going to likely go to 107 to 108,000, and that could be a major top. Well, so far we've seen a 15% pullback off that. We don't know if it's a major top yet because we don't have enough time to watch. In a year from now, if we look back and say, wow, that was the high, okay, that was a major top, or even 6 months from now. As of now, it's a short-term top that may be something bigger. Same thing for the S&P. The 1929 high right here, right? In fact, let me move back to my white line here. So 1929, this is just before the crash, the stock market crash and the Great Depression. We connect that through the dot-com high right here, and lo and behold, what have we just hit at my $6,100 S&P target? That is what we have just hit. I know it's hard to see because it's zoomed out so far, but that is what we're looking at right there. All right, so again, it's not about necessarily knowing for sure. Like, there's nothing in this world of investing that's 100%. You're not going to find it. There's no trader that always wins. There's nothing like that. But the idea is you essentially look at the breadcrumbs and you connect the dots. And you say, okay, what are the probabilities that this could be something major? Well, a trend line like this, okay, this is one breadcrumb. Now what we do is we look for other breadcrumbs. We say, okay, well, that's interesting. I mean, it's something to take note of, but we don't want to make a mountain, a molehill into a mountain, as they say. So what if we look at some of these other charts and we bring up, for instance, the NASDAQ? All right, now, if we look at the NASDAQ here, and I flip back to this bigger chart, as we go back to the big board, we can say, okay, well, here you have a NASDAQ where the NASDAQ composite, this is your COVID low, this is your 2021 bull market high, this is your bear market low, and what did we just hit right here? Well, we just hit the higher range. Now, what we know is this line down here marked the low, and this marked the high. And so by extrapolating common sense and logic, taking out emotion of saying, oh, this market seems like it just goes up forever, we say, okay, well, if this line, which is this line down here, marked the lows, and this is exactly parallel to this line, then it's a possibility, and I say possibility because, again, nothing's in stone, that this could mark a bigger high on the market. Now, you put that together with, for instance, the S&P chart that we just looked at, and then you look at the Buffett rule with 2 standard deviations away from the average, you start to get more and more kind of breadcrumbs in the same direction. And again, I think that's very important to just take note of. And by no means does it guarantee anything. I want to be super clear on that. It's just all about probability. And so for me as a trader, I get much more cautious into these periods where I see this, more so buying puts on the market. I've talked about S&P puts, haven't taken them yet. I hope I didn't miss the trade there, but I'm looking at other things like Apple. Apple puts look very attractive right now, buying out a year, year and a half, looking for some sort of bigger move as, again, the hype is driving Apple up to ridiculous levels. All right. Now let's take a look at a couple other things here, folks, as we get into some bigger movers. Rigetti is having a monster move this morning. This is getting pumped on Reddit. So again, the only thing I have to say about this, in terms of technical analysis, you can still trade these things, but because obviously it's up so much, and this is from Friday's close, so now we're basically at double top up here, nice little resistance potentially. But when they get pumped on Reddit, it's a lot of emotion, which means things can go a lot higher than you think, but it also means for those of you out there that are kind of in a position of, do I jump on board? I don't jump on board. Because what I do know about Reddit, and you can look at GameStop when it ran, once that run is done and the sellers begin, it'll sell and it'll sell and it'll sell. And so just be really careful if you decide to play these things, both on the long side or the short side. People can get burned in both directions, and in fact, most end up doing that. So again, momentum trades are great when the momentum's going, but remember that when the music stops, the exit occurs, and you got to be ready to cut that out. All right, now next couple trades here, folks. If we look at Apple, I was just discussing Apple a little bit. This is an interesting level on Apple here. Again, a long-term trend line, not as long-term as what we looked on the S&P or the NASDAQ, but this goes back to July of 2023. A key trend line. You can see it got hit here, pulled back. It's right into that line again. I did see that Wedbush upgraded again, saying that iPhone sales for the holiday season were going to be good, but honestly, I think that's already factored in. I think it was up like 0.4% this morning or something like that. Tesla's getting a little bounce today. If we look at the pre-market on Tesla, a little bit of a move up here. The only thing I care about on Tesla is this parallel. So we can clearly see you have support down here around the 410 level or so, which we basically kissed in the after hours or so Friday or the day before, and then the upside resistance right here. But if this ever breaks and confirms, that's where you want to be really careful. As long as it stays in here, you buy this for the bounces, but again, if it breaks, you got to exit immediately on that trade. Now, I did tell you guys I would go into a trade that I think is intriguing for the January effect play. So let's talk a little bit about WBA, Walgreens Boots Alliance. Now, Walgreens is not a sexy stock by any stretch, but one of the things it does offer is a profitable company. Yes, they have a lot of debt, no doubt about it, but recently we saw chatter that there was a private entity looking to take the company private or essentially buy them out. And so, number one, if we look at the chart, and we take a look at this, we can see we're trading at a level not seen since 1996. There's a flat top right here that is some key support. All right, we're also right into that level right here. All right, so that's an interesting factor. You then throw in the potential for a buyout. Okay, so let's say they even just buy them out for $15 a share. It's trading at 9-ish, give or take right now. That's a pretty good gain, pretty good upside. On the other side, they pay a dividend, so they're a dividend-paying stock, granted, one that has, as I mentioned, a fair amount of debt, but overall, they still make money. The forward PE is around a 6, which, again, you can't find much in this market around a 6 forward PE at this point, as they make about $1.50 a share, trading at $9. And then the last thing I would just mention is that January effect play. So into year-end, if there's no buyout that occurs, you're going to just see that continual selling pressure from people saying, hey, listen, I got lots of gains in Tesla this year, Apple this year, Amazon, all of these. I mean, basically, if you were long the market this year, S&P up 24%, you've got some big gains if you've taken them, if you've realized some of those gains. Now, what you're looking to do is not pay the government more than you have to, right? And so the idea is, okay, well, if you have that and then you also have WBA, you might say, well, maybe I'll just exit that because it'll cut down my bill in terms of what I got to pay the government. So the tax loss selling is keeping pressure on it to the downside into year end. Once year end comes, you have essentially eliminated those sellers. They're done, and there's not very much sell pressure. And so one of the January effect plays could be a WBA here, which again, If the buyout occurs, that's gravy, but even if it doesn't, you still have that possibility for a snapback. Now, how high could this go? I mean, speculation is you could go anywhere with that. I would just say you look for essentially that there's a gap fill around 1575 or so. That gap fill on the chart would be interesting. That's also over a 50% move to the upside. And so again, every day this week, I'm going to be covering a January effect play. I have some big ones coming up in the next few days as well that I'm scoping out. But essentially using that knowledge of tax loss selling to our advantage and being done with that in January is a real solid way to pick up some easier, and I won't say easy, but easier gains in January on these kind of bottom fishing plays, all right? And again, in general for tax loss, you want to find good, decent quality companies that have, something exciting with them, that are maybe good value in terms of valuation with PE ratios. You don't want to just find a small cap that's a crappy small cap, right? Like something that's a penny stock. Those can still have January effect plays, but what we're really looking for is where the masses are unloading. So a lot of bigger players are in these things, and they're looking to essentially exit into year end, and then obviously the buyers will come in January. All right, next up, let's look at Bitcoin here, guys. Bitcoin has been an amazing trade. Great job. Over the weekend or on Friday, or it might have been Friday morning, I think, I took my profits when we dipped down. So I shorted at 107.10, just using the levels that literally I told you guys in the game plan. So I shorted it 107,100. We covered right down here when it got down in this lower range. I'm going to show you why here. There's a technical level that I've talked with you guys about at 91 to 92,000. Look at that. Resistance, which by the way, if we zoom out, all right, look at that. 2017 high, 2021 first high, second high, and there. I mean, really, this is just the beauty of this institutional level analysis that I'm bringing to your attention. And then sure enough, what do we know is support? There was resistance here. You can see the flat top shelf right there. Broke out, retraced, broke up, retraced, again, hit that level, broke up, and then retraced right there. So you now have a chart where we have resistance at around 108, and we have support at around 91 to 92. Now the question is, you're now stuck in between this, which, you could bounce back here. That's true. Again, we could also come down here and test this level. The key is now as a trader, right? As a trader, we want to essentially be able to, you want to be able to manage it appropriately. So you watch and you say, okay, from between this 92 level, 91, 92, you remain neutral up to 108. If it breaks 108 and really confirms, then back to bullish. If it breaks below 91, 92 and confirms, now bearish. All right, so again, the easy money was made. The 108 level, that was the easy short on it, right? All right, now we are looking to see, well, which way breaks from here, and that will give you your next bias. I would definitely be focusing on the stock market because the stock market, as we saw, when the stock market tumbled last week, that brought Bitcoin in. And so if the stock market starts to tumble in January, that could be a negative. We also saw the altcoins have some big corrections. I also made some nice trades on those with members of Smart Money Crypto. All right. Into gold we go. Gold, again, had briefly broken below here. It never confirmed. It got back above. This is a little minor resistance. You can see how it's causing gold to be flat to negative. Same thing here. Do we get back below and confirm a breakdown, which could send us down to this low at around 25.35? Or do we get back above here, in which case it opens the door to going all the way back to 2,720? All right, silver also getting a small bounce last I checked. A little bit of a small uptick here. It had a big move down on Friday. I talked about the likelihood that you would see this bounce here. I think it could trade back to this line, and then I think it gets rejected and heads down to about 27.5. And then just looking at oil real quick here, folks. Oil, again, I actually am contemplating going long on oil here. There's not a lot of upside, so it's the only thing that I'm kind of thinking about is like, okay, and just to kind of put this in perspective is, when I'm looking at a swing trade, generally I need to know that there's about a 10% upside at minimum. Otherwise, it's like, well, why is it worth your time? With oil here, we have a very bullish pattern starting to form, although I think the upside is probably only about 7%. So looking back at the charts here, you can see we broke above here, didn't confirm, we confirmed, and now we're staying. Look at how it keeps trying to get below. As long as it doesn't close and confirm below, This is bullish consolidation, and the idea being is that the path of least resistance is right now to here, maybe to here. But again, even if it goes to 75 from 69, it's not that big of a gain, just under 10%. So you have to kind of determine if that's something that you're willing to take or not. For those of you that are commodity traders out there, maybe it's a better opportunity. For me, I'm still on the fence on, yes, it's a good setup, but is the risk reward worth it, which is a key component of any trade opportunity. Lastly, natural gas, which has been very strong over the last week. It is pulling back after gapping up last night, my time, when commodities opened at 6 p.m. Eastern time. We see a fade here, so it is coming back in. There's really nothing to do. I do have this trend line I'm watching up around this 372, 373 level, but again, whether or not I trade that, I'm not sure. And then you have this trend line of support right through here. So again, you're kind of stuck in between these two levels here. No big bias one way or the other at this point. All right, guys, listen, there's a lot to go over here into year end. Be ready, right? So it could be a little lighter in volume, but that doesn't mean that, oh, let's go forget about the markets. A lot of people say, hey, I'm just not going to look at it because it'll be slow. What you do is you do a huge disservice to yourself. I myself, and one of the reasons when I go on vacation, I always tune in, I still do the game plan with you guys, and I still do trades, and I still do my videos for my members, is because the second I disconnect, I almost disconnect myself from the ability to really understand the inner workings of the market. And even if it is slow into year end, you want to know every nuance, because when January comes, there's going to be trade setups. And you have to be on point. Because literally, if I tune out for a day or two, I might miss thousands of dollars in gains on easy trades that normally I would be in vogue with, if you will, or focused in on. And so just want to keep that in your point of view, is to really make sure, and again, this doesn't say, hey, listen, you got to be tuned in 24/7, but you do want to stay engaged so you kind of feel connected. There is something about being connected to the markets that enables you to understand the moves and the trades much more accurately. All right, guys, I'm going to get going here. I got to get to my trading room, Apex Live Day Trading. I'm going to be crushing it this week, even with the holiday week, as there's always trading opportunities. Thank you so much for supporting us here at Verified Investing. I'll see you tomorrow. Take care.